Hey, and welcome to another edition of Coffee with Waymark. This edition is a special edition thanks to the July 4th passing of Trump's big, beautiful bill. Uh, Big disclaimer right out of the gates. I am not going to talk about anything controversial here. I am going to say what the intent is and what some of the opponents to some of the bills and some of the provisions of the bill actually have to say. But other than that, I'm not going to talk about Medicaid. I'm not going to talk about SNAP. I'm not going to talk about immigration. I'm not going to talk about the reduction in clean energy credits or anything with regards to education. Those are political hot buttons, and frankly, I just don't want to talk about them because I know that people will have colorful responses to whatever I have to say. So let's leave it there. Let's jump in. So the biggest thing that's probably not getting all that much attention, I would argue is the biggest reason why this bill came into play in the first place is tax brackets. So prior to the big beautiful bill being passed, our tax brackets were scheduled to increase back to where they were pre-Trump, so pre-2017. And so that would have set the top tax bracket at 39.6%. And some of these thresholds where you actually moved into higher tax brackets actually were more condensed. So, in other words, you got into the higher tax brackets quicker. Now we're going to continue where we are, where we have the top tax bracket at 37%. What does this ultimately mean? It's pretty much right here. If you're making $25,000 and you're married filing jointly, you'll save about 7%. If you're making 50, you'll save about 757 or 1.5%. You're making 100,000, you'll save about 2%, 250, 2.9, 500, you'll save about 3.7, and a million, you'll save about 3%. Now, one of the things that opponents of this bill will point to is when you look at the absolute savings here, the obviously if you're paying a higher tax bill and the percentage is right around 2 to 3%, people who are making $1 million are going to save on an absolute basis a lot more than someone paying $100,000. So this is where a lot of the criticism comes in, where this is benefiting the rich. Um, as I said, I'm not gonna dwell on that. That's just what the opponents are actually saying. Let's jump into the actual provisions that I think are most impactful to my clients. So I organized this in a way to say that there are income thresholds, and if you hit the income threshold, you might as well forget about anything beneath that because you probably hit the thresholds for other provisions of the law. So let's jump in. So where we have no income phase outs with the standard deduction. The standard deduction was doubled back in 2017 and is going to continue to be high and also indexed for inflation after 2025. So that's a good thing. Obviously, if you have a higher deduction, that's going to mean lower taxable income, which is a good thing. This one here, the savings account for children, I think this is a small detail, but it gets a lot of attention. All it pretty much does is creates a savings account, and a lot of the details of this are still yet to be hashed out. But long story short, if the child is born between 2025 and 2028, the government puts $1,000 into a savings account, and then you, as the parent, can contribute up to $5,000 into that account each and every year until they hit age 18. When they hit age 18, then it becomes a little bit fuzzy as to exactly what happens with that account, but that will certainly get worked out a little bit further. Next thing here is estate tax, also known as death tax. Now, this is federal only, not state. So let me just start there. And bottom line is it was scheduled to go back to pre-2017 exclusion levels where you would if you passed away with more than $7 million per person, you would get hit with a pretty nasty estate tax or death tax. This is pretty much saying we're going to keep it elevated at almost $14 million or almost $28 million that you can give away from a federal level without triggering any tax. State death tax or state estate tax, totally different. So be careful there, because in Massachusetts, for instance, the limits are still only $2 million per person. Next one here is a cool one, charitable deduction for non-itemizers. In other words, if you claim the standard deduction, typically whatever charitable contributions you make are kind of lost because you're taking the standard deduction that everyone takes, including people that don't donate to charity. This here is actually saying that you could take the standard deduction, which we talked about up here, is $31,500, and then take an additional $2,000 if you're married filing jointly on top of that 31,500, which prior to this you couldn't do. Okay, now we'll get into some of the phase outs. So phase out at $500,000. So if you are making over $500,000, this and everything below it, you can't benefit from. So the SALT deduction, state and local tax. So it has been capped at $10,000. And for people in California, New Jersey, New York, Massachusetts, that's been an issue because people's property taxes and state income tax are typically higher than $10,000. And so you're getting taxed at the state level and not getting any kind of deduction on the federal side. Well, now that's being increased to $40,000, which again is a good thing. But again, two things that opponents to this bill will point to is, one, this is only going to impact richer people, who own a house, and obviously are making good income and paying high state taxes. The other piece of this is that it's temporary. Starts in 2025 and continues through 2029, and Congress would have to enact something new to keep that higher SALT deduction intact. The next one here is if you are making $400,000 or less, you can benefit from a higher child tax credit, which is fantastic because credit is better than a deduction. It's actually a dollar for dollar reduction on your actual tax bill, which is great. Again, another thing that opponents are going to point to is that starts in 2025, ends in 2028. So it's another temporary bump to the child tax credit. Now we get to the $300,000 phase out. Taxes on tips and overtime. So at this point, any tipped income up to $25,000 or overtime income up to $25,000 for joint filers is considered an above the line deduction, which means that for all intents and purposes, that income is tax free. Now, again, that gets phased out at $300,000, but typically people who are in tipping industries or overtime industries are not earning more than $300,000, so they actually can benefit from this tax deduction. Next one here at $200,000. So if you're making less than $200,000, if you purchase a car and that car had a final assembly in the United States, in other words, could be produced all over. You could source components from China. You could build most of the car in Mexico. As long as the final assembly is made in the United States, then up to $10,000 of auto loan interest is deductible. Now, again, not a huge benefit, but still a benefit. Let's just use a basic equation here. Let's say you have a $50,000 car at 5%. That's about a $2,500 deduction that you can claim, again, only between now and 2028. So another temporary tax break for you. And then the final one here is huge, but it only is eligible for people making $150,000 or less. A lot of my senior clients are making more than that, whether it's because they're a teacher who has pension money and it increases. Or the other piece of it is required minimum distributions. Sometimes that'll push your income into the 150. But if you can get access to this is huge for seniors. And just as a little bit of a background, Trump campaigned on eliminating Social Security tax for everyone, for seniors, but he wasn't able to push that one through. And this is kind of in lieu of that. So what this pretty much says is that you can still claim the standard deduction, which is up top, but in addition to that, you also get $6,000 per person. And then on top of that, you also get the $3,200 of enhanced deductions on top of that. So you can get well over $40,000 of deductions if you are making less than $150,000, you're over the age of 65. This is a pretty big deal for those people. Okay, I tried to keep this as short as I could. There's a ton in this bill, and I tried to avoid all the political landmines. So hopefully I accomplished that. Hopefully you find this interesting. And remember, as we always say, be well and do good.